Well, good afternoon, everyone. Welcome to our webcast on getting started with stock investing. I'm Connie Hill, Senior Manager and Investing Coach here at Charles Schwab. I have a question for you. How many of you have had this situation where you kind of get too excited about things and you load up on them? Like you find something on sale and you're like, oh, let's go get a bunch of it. Has that ever happened to you? Well, one of the things we're going to talk about today and focus on is managing our risk when getting into trades. And it's something I wish I had understood better when I was first beginning my trading and investing. It was something I really didn't have an idea, but it's going to be one of the most important concepts to you being able to have longevity in your trading. So we're going to spend some time on that. And at the end of the day, I hope you're able to know how to manage risk in any single trade you might want to get into. Now, I am joined in the chat by Kevin Horner. I'm so glad Kevin's here, fellow friend and coach. He's very knowledgeable, been trading the markets for years and years. So as you have questions, go ahead and ask. Kevin will try to have my back as far as maybe some things I don't get to, things that he might be able to help out with. But feel free to put in your questions. And those of you that are listening to this on the recording, I know lots of you do, when you have a question, put it in the comments section, and then I'll go back and review those throughout the day so you can get your questions answered as well. So don't be shy. Let us know what is on your mind. Now, I hope you're following us on X, all of us as coaches. I'm at Connie Hill CS. Kevin is at Kevin Horner CS. Post out educational content throughout the day. Sometimes some coaches will put out inspirational things as well. Just things we think you might find helpful is what we post about. Of course, it's free to do and to follow us. Doesn't cost you a dime and gives you an extra point that you can interact with us outside of our classes here. Well, let's go ahead with our disclosures and I'll lay out our agenda and get into the numbers. Now, I'm going to give you a little warning. Today has a little bit of math. It shouldn't be too bad of math, okay? But I do want you to know there is a little bit. What we talk about today is intended for educational and informational purposes only. Shouldn't be considered a recommendation of any sort. We will be using the download Paper Money Thinkorswim software. It's the software you download to your computer. It's the most robust version of Thinkorswim. It's a little bit different than the web version for those of you that might use that. Investing involves risk, including the loss of principal. Now, this is a little bit of an overview of many of the topics that we cover in this series. And there's a series 1 through 6, and then I've been doing some bonus sessions, okay? Today, we are in this block over here called risk management. And I can't tell you how strongly enough that it's just going to be critical to your longevity in trading. So let's talk a little bit about risk and emotions that can happen when we're investing. And then I'm going to teach you a systematic, programmable way, maybe not programmable, but arithmetic way that you can decide how much risk is appropriate for you to take on in your portfolio. Of course, we're going to look at some examples here as well. All right. There are definite benefits to managing your risk, and the reason that we do that. And, you know, some of the benefits are for you are going to be making sure you preserve your trading capital. When we're new in the markets and we don't know a whole lot, it's easy to make mistakes. But if we limit the size of our mistakes so that they can be small little mistakes instead of gargantuan mistakes, that really will help us out. Another thing that will happen to you is it allows you to develop some discipline so that you know, hey, when this happens, when X happens, then maybe it's time to get out. And that's either on the side of making money or locking in profits that have been unrealized up to that point, or if it is trying to minimize any losses that you have. And it also helps you contain your emotions. I don't know if any of you can relate to this when you first started, maybe even doing some paper trading, that it became a little bit emotional to you, right? You're like, whoa, this is money. And you're maybe surprised at the swings in your emotion when you start trading. But again, if you limit your losses, because they're just going to be part of trading, even though nobody wants to lose money, it's just part of the arena. All right, if you can curb those emotions, that will help you a whole lot. So losing is part of the cost of just being able to trade in the marketplace. Some people say, well, I never want to lose any money. And the answer is going to be, then you're not going to be trading. All right. Because you always have to have some sort of money at risk to participate. And this middle bullet here is really interesting, that you'll never learn how to win or to take profits or to manage your profits if you don't know how to manage the risk, if you don't know when you should be out of certain trades. And psychologically, it is more damaging to a trader and an individual, okay? The damage that losing trades have on the psyche is more negative than the positive on your psyche when you have winning trades. Okay, kind of an interesting thing. People might sometimes dwell on, oh, I happen to lose money on this one, and therefore I'm not a good trader. And that's not the case at all, right? It's just going to be, if you're going to trade, you're going to have to know that sometimes you're going to have to lose some money. Now, I want to show you where the information we're talking about here today, where does it come from? We're going to come over here to we're going to come over to Charles Schwab here. I've logged in. And so you would have to go ahead and log in, then come to this Learn menu. You hopefully can see my giant hand there. And then you're going to come over to Courses. Now, most of the information that we're reviewing and going through is from this third course down, Stock Trading with Technical Analysis. And really, it's a great building block for you. If you haven't gone through this course at least once, I'm going to highly recommend it. If you have some time over the holidays and you haven't done that, take some time to do it, because it's going to reinforce what we talk about here and allow you to have some basic principles in place that you can continually add to throughout your trading career, your trading life. Now, as we come into the different lessons here, we are going to come to Chapter 4, Lesson 4, Money Management. All right, and that's where these concepts come from. Another place the concepts come from is the Sample Investing Plan. I hope that you have downloaded this or printed it out. Just have reference to it, okay? Because you kind of want to be building your own plan. We give you a sample investing plan to work with. Last week, when we got together, we focused on entry signals. All right, we did what do we want on a watch list, and then once we have a watch list, what do we look for to get into the trade? And then money management and a little bit of exit rules are going to go together here today. Now, the suggestion is made, don't risk more than 0.5 to 1% of your portfolio in any trade. Okay. We're going to implement that rule here today. And then as you become a little bit more experienced, and this will be, you'll just kind of have to judge this. Sometimes people might allow that to creep up a little bit, maybe to 1.5%, 2%, maybe 3%, but still wanting to keep it very, very manageable. And one thing I want you to think about is, if you had a trade along a bad trade and it hit your stop loss and you lost money, could you handle that? Could you still sleep at night, even if you lost $500 in a trade? Could you still sleep at night if you lost $1,000 in a trade? Now, that's going to vary depending on your portfolio size, right? If we're talking about a $100,000 portfolio and we were risking 0.5%, that would be your $500. Okay. What if you hit your $500 5 times in a row? Whoa, that's a little more damaging than just once or twice, right? But if it's contained, you're down 2.5%, maybe because you had 5 bad trades in a row or 5 trades that hit their stop losses. Then could you still be able to recover your account? Yeah, I'd say in most instances, yeah, you'd be able to overcome that and come back. But if you were losing 5% a whack, okay, if you're risking 5% on 5 trades, that would put you down 25%. Yeah, that is much harder to recover from than just 2.5. And remember, when you're new, you don't know everything. You're trying to know everything, and you're practicing things in your paper money. But it's hard to learn every single lesson you're going to encounter, right? So just know, hey, you're going to practice things that we talk about till you feel comfortable that you can take them over to your live account, okay? And money management is going to be one of those things. Wiley, I appreciate your comment here. Wiley says, if you go through the course, it really reduces your learning curve and definitely help that. And I appreciate you chiming in with that, Wiley, because it's absolutely true. Now let's come over. We're going to come over to Thinkorswim here, and we are going to look at our first example. And the examples that we're using today are stocks that I got off the watch list that we created as a class 2 weeks ago. I taught you a scan, and in that scan, it brought back, it was actually StockHacker, it brought back several ticker symbols that we have been using the last couple of weeks. Now, this is a class for beginners, and sometimes when you come into some material you are not familiar with, you might feel a little like we're feeding you with a fire hose, and I get that and I understand that, okay? Keep coming back. I want you to be stretching. I want you to be learning new concepts. I want there to be new vocabulary for you that you get to know over a short period of time. But if you don't get everything in this initial session we're having right here, don't worry about it, okay? Or if you're here for the first time, go ahead and let us know that. But for you, and if you're really green in the markets, you might want to go back to the recordings, go out to our YouTube recordings after you've become a subscriber. It makes it really easy for you to find. I'll show you that later. But you can go back to that very first lesson if you're feeling like, man, I don't think I know enough yet. Okay, so I do want to give you that encouragement. Now, over in my little scratch pad here is the formula that we're going to use today. Okay, this formula says we're going to decide on our portfolio risk. And so this sample account that we work in a lot, we say we have $150,000 in that portfolio. Your number might be higher, it might be lower, it doesn't matter. You would put your number in there, whatever your portfolio size is. And then if we only want to risk 0.5%, then that's multiply that by 0.005. Okay, that would give us $750 that we would feel comfortable risking in any trade. Now you would adjust this if your portfolio size is $20,000. Okay, in a $20,000 at say even 1%, then you would be risking about $200. Sometimes when your portfolio is super small, you may have to work with a little bit bigger numbers just so you can actually invest in the markets. Okay, so that you can even practice. Okay, so that is going to be the first thing. So on our sample portfolio, we're willing to risk that $750. Now the next step is specific to each stock. Let's go back here to our slides for just a moment. And here's our $100,000 in our slides here. We're using $150 in our example trading account. And here, they're giving you the risk tolerance of 2%. Again, that might fit some of you, it might not. You might not feel comfortable even going high, and that's not that high, but you might not feel comfortable at 2%. Okay, you might feel more comfortable starting really low and then maybe building up as you develop your confidence and your skills in what you're doing. Now, this next piece is what we call position size. And really what it means is how many shares can we afford to buy and still keep our risk in check. All right, so example here is you have a stock, and we're just going to use nice round numbers. It's $30, and then you decide that if things are not going well, you maybe need to get out at $28. We'll go through a real example and how you actually decide that. Okay, but just for illustrative purposes, that gives you $2 of risk on the trade. Okay, we take what we're willing, our maximum risk here of $2,000, and we decide we got to take this risk here, this $2, we divide that into the $2,000, and it'll tell us how many shares we don't want to buy more than. And it doesn't mean you should buy exactly 1,000 shares. You just don't want to exceed that number using this little formula here, okay? Now, let's talk about risk and reward here a little bit. Sometimes shorter term traders might have targets that they have in mind. We don't always use targets in all of our trades, but say, for example, if you're trading the flag pattern, Flag pattern, we may have a target of how high we think that flagpole is going to go again. And that would be our target. And so we'd basically say, okay, our entry price, take that from where our target price is. We think maybe we have, say, example here, $36 might be our exit. And so the price we get in is at 30, and we'd say, okay, our reward, our potential is going from $30 to $36. We call that the reward. And then the risk side of the trade is going through the step that we just went through. We say, okay, what's your entry price minus your got to get out of price. And then you can go through and do the math. And you'll say, well, I am risking $4 for every $6 I have of potential reward. Okay. We won't dwell on that a lot, but if you are of that mindset of doing some swing trades or playing or trading kind of like, flag breakouts and having a target in mind, then you'll want to keep this in mind. And the idea is to risk a whole lot less than what your potential reward is. Some people might want to say only risk $1 to make $2 or $1 to make $3, right? That seems very favorable. I would say a minimum that a lot of people might decide to use is that 2-to-1 ratio, risking $1 to make $2. Now let's go out to our Thinkorswim. Let's go see how we might put this in practice. Now, one of the stocks that was on our watch list, I called it Growth 12/6/24, because that's the day we ran the scan. And I said, I'm just going to kind of go through these stocks here. Let's see if any of them have an entry signal. All right. So for our one stock here that we're going to use as our very first example, Victoria's Secret. Has it been upward trending? Yeah, it really has. This blue line is a 10 period, so a very short-term moving average. This red line is a 30 period, which is more of an intermediate average. Now, you guys know what happened earlier in the week, right? We had kind of a significant pullback in the market. Today, we had, I'm going to say, a pretty strong bounce in the market that impacted a lot of different stocks. Now, as I pull up this stock, and let's suppose we're analyzing it for a minute, we can see we had a flag pull. We had a flag here, and we got in here not knowing that it was going to flag out, but it did. Okay. This was for a different class. It wasn't actually in this class. And then we would look for the breakout above this consolidating flag area. Well, it didn't happen, right? Instead, the price of the stock pulled back. Now, it didn't even get as low as the 30-period moving average, which gives you an idea. Hey, it held in there pretty well, despite the a couple of days of selling off that we saw earlier in this week. The other thing I would note here is we're getting a bounce, and I would go back and say, well, where was the previous low? Well, really, the previous low is down here. Some people might go to that candle there, but it's certainly a higher low that lets us know, all right, the trend is still intact, all right? And then last week, we talked about certain things we might look for on the chart, looking for something very specific that says you could, if you wanted to follow that rule, you could make an entry and do an example trade in your paper money account. So here, the one thing that I would kind of noticed is it pulled back to here. So we kind of have an uptrend. We have a little bit of a pullback. And what happened today? Well, we got this, what we call that hold signal, the close above the high of the low day. Yesterday's candle was yesterday's lowest point in its pullback. And we can see the price of the stock closed here today, which was higher than the high price of that low candle day. So that would be our hold entry. Now, another thing here is you'd say, okay, if we're going to put in an exit at the same time we're putting in an entry, where do we even calculate that? Where would we do that? So we might look at where is support right now for the stock. And, I can see a pullback here, and we've got a couple of days here, but it really, it wasn't like it was an old resistance over here that might become new support, but it could be bouncing here. The other thing I would see is, it really has done well staying above the 30-day moving average. And so we might go a percentage below this 30-day and decide that's going to be our stop loss area. Now, wise, you get to decide how far below. Technicians that are noted and published and respected, many of them in their writings have said if a stock penetrates resistance by 3% or more, it's likely to continue to go. That also means if it penetrates support and breaks down below support 3% or more, then the likelihood it could continue down. Now, neither of those are guaranteed, but if you know that, you might say, well, let's give it that wiggle room. Let's give it 3%, and then we'll put a stop loss there. So we're going to use our calculator. Let's collapse our watch list here. And the 30-period moving average is at 40.79 right now. So let's use our calculator, 40.79. We're going to multiply this by 0.97. Why 0.97? Because it's the quickest way we can go 3% below any number, whether that number is a flat support level, diagonal support. In this case, we're going to use the 30-day moving average, okay? This says, all right, we could consider putting our stop loss at 39.56. Now, something that's helpful to do is go put your mouse in that area. Okay, so I'm going to find 39.56. Ooh, that's pretty close, 39.55. If you're not comfortable putting your stop loss there, figure something else out. Maybe 5% is more comfortable, 5% below that average, or 5% below support. And there will be some stocks that are really volatile that may be the case. So if you are not comfortable at this level, okay, then just choose something else. For our purposes, so we can go through and use the formula, we are going to stick with that 39.56 as our exit point. Okay, so now we are going to do the position sizing. How many shares, given that risk, can we do on a trade? Well, if our stop is going to be 39.56, our entry, we're going to hope is pretty close to 44.96 on Monday, right? We'll go ahead, we'll put it now in the order in now, and then in Monday, it should kick in. So we have 39.56 minus, we're going to put in 44.96, which was the last price today. And that tells us our risk per share. Okay, so $5.39 is the risk per share. Then we say, great, we'll take our portfolio risk, which in this case is $750. Get the right number in there. And we are going to divide that by $5.39. That says we could purchase 139 shares. We don't want to go more than that. I know it's tempting to round, okay, but just be very methodical about it. Don't worry if it's an odd number, okay? That's not a big deal, not at all. Now, we'd say, okay, 139 shares. Now, some people like to go one step further. And the one step further is, well, if I were to buy 139 shares, how much money am I spending? Because some people will say, I don't want to spend more than X% of my portfolio in any single trade. So some people might say 10%. I don't want more than 10% into any single ticker symbol or trade. Some people might say maybe even more than that. Maybe they want to divide their portfolio up with, say, 15 positions. Okay, and then their tolerance or what they would allow themselves to spend might be a little bit lower. So let's go with this scenario that we don't want to spend more than $15,000, which would be 10% of our portfolio on this trade. Okay, we're going to buy 139 shares, and we're going to multiply that by 44.96. We would be spending about $6,250. Okay, is that less than 15%? Absolutely, absolutely. So you would say, okay, it's just taking up a real small percentage of my portfolio and feel comfortable buying that many shares. Now, you may run into a situation where you are taking a bigger, say, risk on the trade. And in those cases, most of the time, I shouldn't say most of the time, do the math, figure it out. Sometimes when you have a very little bit of risk, sometimes that puts you in a situation where you're buying a lot of shares because you're like so close to support. And in that scenario, yeah, you run that second calculation. How much money am I going to spend? And sometimes you'll exceed that 10% or whatever percent you want to go with. All right, so let's do this. We're going to put in our stop loss. We're going to buy 139 shares of this stock. All right, so off we go. Let's go to right mouse click, buy custom with stop, so that we're going to put it in all at the same time. We're going to adjust our quantity here to 139. And then I like to click on that little paperclip guy and make sure that the quantity is the same in our buy order and our sell order. All right, 44.90 is what this price is coming in at. That's fine. Let's go ahead and put in our 39.56 as our stop loss. And then we're going to want to make it good till canceled. Now, if the price of the stock goes to that, missed it by 6 cents. Let's get our 6 cents in there, 39.56. All right. If it goes to that price or lower, the stock, it's going to trigger what we call a market order. And a market order just says, fire me, fill me at the next available price. I need to be out. And you're not quite as concerned about the price. You're more concerned about getting out. Okay. So make sure you understand that's what happens on these stop market orders. Good till canceled, so we don't have to go set it up every day. And then this is just a little warning saying, hey, with those stop our orders, your price is never guaranteed. Okay, so it's just a little reminder to you about that. All right. Now, suppose we've gone through this one exercise of position sizing and you're like, I'm feeling maybe like this is a little too much, or maybe I came in too soon. Well, let me show you how easy it is to go find previous recordings that we've done. I'm going to jump over here to back to our browser window, and I'll come over here and up to the top menu, and we're just going to come to Schwab Coaching right here at the top. Brings you to our coaching page where you makes it easy for you to find access to classes. Okay, so that's one place that you can find our recordings. The other place is if you're on our Trader Talks channel. Okay, so if you're out in YouTube and you've hit that button on the bottom, that YouTube button that's blue that says subscribe, that'll subscribe you, and then it makes it pretty quick and easy. You'll notice we have essentially what's coming up next. So when I launch the page, this class hadn't started yet. Our next class will be Monday morning, right at the opening bell. Kevin Horner and I think Mike Fairborn are going to be, no, it's not Mike Fairborn, it's a different Mike, are going to be leading that discussion and session. Okay, so that's the next class. And if you're like, oh, notify me, let me know about it, because I don't want to forget, you can do that. Now, if you're looking for our playlist, and say, for example, this was too much and you're like, I kind of want to go back. All right, what you're going to do is scroll down here to the playlist. This one's near the bottom here, Getting Started with Stock Investing. You could just click on play all and it's going to bring up all the previous sessions. Okay, so that I think probably was last week or a couple of weeks ago. And you'll see all of these in sequence, going back a week, going back a week, going back a week. So if you're brand new and you're like, this is a little too hot for me, Connie, no, it's a beginner class. Okay, something you might want to look at this weekend is just kind of going back to the previous ones. Number 1, 2, 3, and then today will be put in as number 4. Okay, that's how easy it is to do. Now, something I need to tell you about with our calendar, let's get back over here, is the time for this class is going to be changing. As you know, we're rolling out some new classes, rearranging some of the times, doing some combining of classes. I'm really looking forward to what we're going to have available for you starting in January, but this class is going to change. So let's go into our calendar. Let's jump over to January, and it is going to come on here. It's actually going to be on Thursdays. Instead of Fridays, it's going to be at 3 p.m. Eastern time. That's when this class will start. So it will be during market hours, which will be nice. I know some of you really like to be able to have that. Kevin Horner is going to be teaching the class from now on in coming January. And then in this spot is going to be a class called Market Movers, which basically is kind of what things impacted last week, what's coming up this next week that could very well impact the direction of the market and what we're doing. Okay. So those will be some good ones for you to do. Kevin, thank you for posting that playlist in there. Now, I'd like to show you another example. I think you guys would like to see one as well, but I'm going to get your input for this next trade. What I want you to do is I want you, whoever wants to, submit a portfolio size that's different than our 150,000 we use in this class, and your risk tolerance. We've used 0.5% in our first example, and I'm going to have you, I'm going to pick from one of you that submits an answer to me. While you're putting that in, I'm going to go back over to Thinkorswim. We're going to look at our second stock. Again, this came off of that watch list. Ticker symbol here that we're going to use, there's Victoria, say goodbye to Victoria, is Insulet. It's a company that delivers insulin solutions and systems to people who need that, okay? So PODD is their ticker symbol. Again, was on our watch list. And what happened with it? Well, it had a good earnings report. It gapped up here. And then it kind of waffled around a little bit, right? Ran for a little bit, but notice it really didn't break down below what we call the bottom of the gap. The gap is this space right here, where it closed one day here, and then the very next day, it opened up clear up here. And so this space in between is called a gap. So many times the bottom of that gap, which would be like the bottom of the candle there, if I were to maybe activate this and maybe drag it just a tad lower, many times that'll act as support. Many times you won't see the stock dip below there. Now, sometimes it does. It goes and fills the gap. But notice what it did here. Did it stay above that area? Yeah, it did. It today is just having a nice little support bounce. It looks like it's closing above maybe the 10 and the 30, or at least it's close to that. Yeah, it's closing above both of those moving averages just by a few pennies, okay? What kind of an entry, based on what we talked about last week, would this be? Well, some people might look at it as a hold again, saying, well, here's the pullback, and today it clearly closed higher than the high point of that low day. Some people might see it kind of as a support bounce, and I think either one of those would qualify for this type of an entry. All right, did any of you submit a portfolio? You didn't. Well, I can't go from your suggestions if you're not going to put them in. Let me just refresh, make sure I'm getting the chats in all the way. Sometimes as coaches will find a little hiccup for some reason. Okay, well, I'll tell you what, we are going to put it in. Oh, Howard's going to help me out here. Thank you, Howard. Okay, so Howard has said, what if we use $100,000, our portfolio, instead of the 150? And we could use, again, that 0.5% or even 5%. Okay, so 5% might be a little on the high side for some people. And I would say if you're brand new, which a lot of you are, be really careful. Okay, the suggestion is maybe not going above 2%, but do you know what, Howard? I said I would do what somebody sent in, so we'll do it times 5%. So we're going to multiply our $100,000 account by 0.05. Previously, we did 0.05 because that was 0.5%. And so what are we going to end up with here? Yeah, Howard did the risk for us. We're going to be risking $5,000 per trade. Now, again, if you have 5 that it comes down and hits your stop loss and you lose $5,000 on 5 trades in a row or something, that can be kind of difficult. Okay, so I'm going to use the example, but just know the suggested range is much lower than that. Okay, but let's run through the numbers. Let's do it with this stock. So it held above support quite nicely. So we could, in this circumstance, say, well, let's go 3% below wherever this line is. Okay, line's at 253.74. And so we're going to figure our stop loss out first, where we need to be out. Because if it breaks down below this support, it could continue to go down, right? Because support should hold you. That's where the floor should be, should sustain you, okay? So we're going to do that. the 253.74 times, again, 0.97. Oh, nope, we're doing 0.95 because of the higher risk tolerance. Well, no, let's leave it at the 3%. 3% below. We'll be consistent here. So 0.97 here. All right. That gives us a value of 246.12. Okay, if I go to 246.12, where's that going to put us? Pretty close to where my mouse is. Okay, that's 246 and some change. Yeah, if it were to go there, you'd probably feel like it was violating support, as opposed to if it just went like maybe just a smidgen below it. Then you might go, support's an area. You can be in that area, right? Really want to give it that wiggle room to be in that support area. Okay, so our stop here on PODD is going to be 246.12. Okay, let's figure out risk per share. Okay, so we're going to take our 246.12 and we'll see if our number will stay in there and subtract it from what we're likely to get filled at. Okay, this was the last price. So 266.57. Take the difference there. Wow, this is quite a bit more risk, isn't it? Okay, and it's true. It had a decent day today. It was up 3.9%. But that says we could buy 20 shares of this stock. And again, it's a more expensive stock. All right. So we're going to go through. We could buy 20 shares. Now, let's make sure we're not spending too much money on the trade. Okay, if we said we could buy 20 shares and we're going to spend $266.57 a share, really that's only $5,331. Is that below 15%? It is, below 10%. Now we're working with a $100,000 portfolio. We're willing to risk $5,000. Let's do this math one more time. Okay, I'd said it would be 20 shares, but I think I may have missed a digit here. So let's do this again. We're willing not to risk $750 per trade. We're willing to risk $5,000 per trade. So let's make sure I've got that in there and divide that by our risk per share, which is actually in this case, we need to do it. We need to go 246.12 our stop from, I just kind of did it on the fly in the calculator. Okay. And that comes out to that $5,000. Make sense? All right. So let's go ahead. Let's say we do buy 20 shares. Okay, our 20 shares times 266.57. All right, this number out here says we would spend in the neighborhood of $53.31. Now, of a $100,000 portfolio, that's going to be a higher percentage, isn't it? So that's going to be in the neighborhood of about 5.33%. Is that easily below 10%? Yeah, it definitely is. Definitely below that. Now, if you didn't want to risk as much, okay, we kind of talked about this 5,000 maybe being a little bit rich for the portfolio, especially for somebody that's beginning. You just substitute your number here, whether it was the 750, whether it's 1,000, whatever that number is, okay, you would substitute it there. And typically you're going to end up buying a few more shares in that case. Now, Howard says 5,000 is the position risk, 500 for the portfolio risk. I misinterpreted that, Howard. I apologize. Okay, you're saying really you're only willing to risk $500, not $5,000. Okay, I apologize. I misinterpreted what you were putting there when I saw 5% and then parentheses 5,000, and you really meant that's all you're willing. Gotcha, we're only going to risk 500 per share. We'd replace that instead of 750. So what we'd do, let's just do it one more time, not having the huge stop or the huge portfolio risk of 5,000. Let's just do it of 500. Okay, 500, we'll put dollars there, is our risk. Okay, so We'll use your numbers right here, Howard. Okay, if your position risk is 500, and we already know risk on the trade is, where did that number go? I think the I think I didn't write it down here. The difference between 266 and 246. Okay, so let me just kind of get that in there. 246.12 is our stop, and our entry price would be 266.57. Okay, $20.45. All right. Then what Howard's saying is, no, then let's divide that by into $500, not $5,000. Okay, so let's just restate that. So willing to risk the 2045 into $500. I think that's what you're wanting to do here. If I'm wrong, you can correct me. But if you're really only willing to risk $500 per share, 500 divided by 2045, 20.45, okay, that would give us 24 shares that we could buy. All right. Well, I thought it was going to be fun to use an example from one of you, and I apologize that I misinterpreted what Howard was really getting at there. Yeah. He says, yeah, 5,000 is way too risky. Yeah, he's on board with that idea. Absolutely. So let's go ahead. Let's do our 24 shares. We're going to do the buy custom with the stop. We said we could do no more than 24 shares. We'll put in our 24 shares. And then the price coming in here is a little bit higher than the last price, so I'm going to adjust that. 266.57, and we'd hope we could get filled on Monday at that price. And then our stop loss price here, 246.12. And we'll make sure that that's a good till cancel. If it gets to that point or lower, it's going to trigger that market order and just get us out of the trade. Hopefully it's close to this price. That's our intent, but it's never guaranteed to be exactly that price. All right. So there's our order. Just kind of review it. Make sure you didn't buy 2,400 shares instead of just 24, right? Just check your numbers, and then we'll go ahead and send that in. All right. Hope that that clarification, going back, clarifying on that example, hopefully that helped. One thing I'm going to just show you real quick as we wrap up here. This is just kind of something that I think is interesting that kind of shows what we've been talking about. Last week, we put in this trade on CLS. We bought 50 shares. We were practicing our entries on that trade, but let's CLS. And what I want to show you is what happened in the last week. And I'm just going to kind of zoom in here. We saw this was kind of a breakout area. It looked like the stock was bouncing off of it. This was Friday when we looked at it, and then we got filled on Monday. Well, in the pullback, did it have a pullback? Yeah, it had a little bit of a pullback like other stocks. We had put our stop 3% below the 93.05. It didn't get hit. Now, if it went down there and did get hit, would probably be happy about that, to be out of it and not following it down. But kind of bounced in that area. That gives us the idea that, okay, that support, that area, the stock is honoring it. It's honoring it as support. And then what will happen is, as this moves up and creates a new support level, then we'll want to move our stop loss up, help try to take advantage of locking in what has been unrealized gains, and try to do that as the stock continues to move up. Okay, so I just wanted to follow up with you on that little thing from last week. All right, who feels like you can go and do this formula? Do you feel like you can go out to your portfolio, decide how much to risk per trade, decide how much of your portfolio you're willing to risk, whether that's 0.5% or 1%, whatever that happens to be? I hope you feel comfortable that you can go do that now. All right. So if you want to let me know that you're feeling comfortable with that. If you're not, just go back once this is posted, just go back and review it And then I think from now on, whether it's a paper trade or you start getting into live trades, you can run that formula on any of your trades. And once you go through the process a couple times, you'll get really quick, right? You'll just be typing in the numbers in the calculator and it'll come easily. Maybe this first few times as you're exposed to it might be a little bit slower, but you'll find you'll catch on really quick. It'll go pretty quickly for you. All right. This is the last of this class for this year. Again, we're going to start on Thursdays at 3 Eastern time with Kevin teaching the class. So you guys have a great holiday. Have a great Christmas, Kwanzaa, whatever it is that you like to celebrate. New Year's. Hopefully it's just a good time to be with your family and friends. And we will see you all next week, bright and early. Don't forget to subscribe. Don't forget to follow. There was no survey today. But as Wiley said, if you want to give us a thumbs up on the way out, if you found this helpful, that's always helpful for others to be able to find this session as well. All right. We'll see you then. Bye-bye.